You recently changed some of your allocations, the way you allocate money, that actually included lumping private equity with public equities. Can you explain a little bit about why you did that?
Sure. It's good to be with you, Lisa. The reason that we do it really starts with our mission and why we invest. And we invest on behalf of our 170,000 members to pay benefits today and into the future. And accordingly, we have some assets that are safe, provide downside protection, such as investment-grade fixed income. And then we have others that help grow the fund to pay benefits into the future, and that predominantly includes investments writ large. And across the equity spectrum, we have some investments that one way to say it is, all other things being equal, we would like to invest in the lowest cost, most liquid form of an exposure to gain access to that factor. And in some cases, we do that through public equities. In other cases, we do it through private equity. But fundamentally, equities as a whole give us exposure to long-term growth.
So, John, recently you've been reducing your allocation to equities broadly, but in particular, public equities. Have you also continued to reduce private equity investment?
Well, still, public equity is our largest single investment strategy. We have not reduced our exposure to private equity. That's still about a 10% allocation. Both, as you mentioned, public and private equity both reside in our growth portfolio. But we've allocated our asset categories more broadly, somewhat more defensively, but to allow the fund to perform in multiple investment environments, not just the one we've had over the last decade that's really been dominated by growth and low inflation.
So given the low interest rate environment, have you reduced your annualized returns expectations going forward?
It's interesting that you ask, because right now our board is in the middle of what's called an experience study, where we look at many of the actuarial assumptions used by the fund, one of which, or a principal one, is the investment return assumption. So it's something that the board is in the middle of a very deliberate process to evaluate. So we haven't reduced it, but it's something that the board is looking at. But part of this exercise, because we believe that we are in a more muted or lower expected return environment that's somewhat anchored by, a 10-year at, you know better than I, at 1.85 or so today. That really forces us to really look to optimize all aspects of our model. In addition to our return assumptions, we want the sharpest implementation possible. We want the best of breed implementation, and we really look to eliminate all the low-hanging fruit and to really prevent the portfolio from working at cross purposes. For example, if we have one manager that's long Apple, another that's short Apple, we need to understand that total exposure as opposed to paying excessive fees for what may in aggregate be just a market or neutral exposure.
Which actually brings me to my next question. How much do you look at fees in determining which manager to work with and perhaps which managers to cut?
It's interesting. Fees are certainly a very important topic for pensions, for all institutional investors. Here in California, we have an annual disclosure that we make in a public session for all private assets. So we do look at fees, but we think it's more complicated than just looking at fees, because if we were to build a portfolio just focused on low fees, it may not optimize our returns. So we look at fees as one of 4 or 5 different dimensions, some of which are quantitative, others of which are qualitative, and it creates things that include returns, performance, things that look at operations. We take into account something that's very important, our ESG considerations, the strategic value of a relationship, diversity and inclusion, and fees are one of those factors that we use in our comprehensive analysis.